Hello my fellow freedom builders and welcome to the channel. Now today we are going to touch on a topic that I haven't touched on in a really long time here on the channel, and that is called Monte Carlo analysis. And yes, I know I might have been a bit clickbaity when I chose a picture of the Monte Carlo casino, because we are actually not going to talk about casinos today, even though it is a bit related because it is a statistical video. And now, before you turn this video off because you're thinking, oh no, math and statistics, that's not for me, I promise you it will be easy. And I also promise you that if you watch this video to the end, it will become a huge factor in you being long-term profitable. It will mean the difference between you going broke and blowing your account and you actually ending up making a living out of trading or investing. I know it can sound a bit sketchy, but this is a numbers game and I'm going to show you all about it today. Now, if the thumbnail and the start page shouldn't look like this, it actually more should have looked something like this. Monte Carlo analysis. This is what we're going to look at today. Let's have a look here. This is a Monte Carlo path or a Monte Carlo chart, because a Monte Carlo analysis is basically where you are looking at the probabilities of different outcomes. And this can be anywhere. It can be in a nuclear reactor, or it can be in managing an organization or whatever. But it can also be in trading. And if this was in trading, you might have a trading strategy that gives you a certain number of wins, a certain number of losses. Your winners are at a certain amount and your losers are at a certain amount on average. Then you can ask a computer to say, all right, if I took 100 trades or 500 trades in a row and I did it 100,000 times, where would this probability cone be at? Meaning, what would be the worst case if we ran a simulation of 500 trades 100,000 times? What would be our worst case scenario of all of these many thousand runs, and what would be our best, and what would be the most possible or probable scenario? All right, I know that might sound a bit statistical and math-like, so let's try and have a look. First of all, today we are both looking at stock investing, but also some shorter-term trading. And I would like just to put in a word for our sponsor here, NSB. I'll put a link to it below, and I'll also tell a bit more about it later in the video. But they are our sponsor right now on this channel, and they are making it possible for us to cut down on the ads that are running in the video here, so that you get a more smooth video watching here. So thank you to NSB. I'll just tell a bit about them later. But let's go to some Monte Carlo analysis here. Now, this is an old Excel spreadsheet that I bought once way back, and I'm just going to show you a couple of details here, but I'm also going to show you a website where you can do all of this for free. But let's say that we have a stock investment strategy. And first of all, to get these statistics I'm showing you here, you need to have some stats on your trading. It's no good just to sit and trade, and one trade here and one trade tomorrow, without plotting them down. You need a trading journal, and you need to do some back testing, and you need to have a decent idea that you are actually having, let's say, a 60% win rate. And this should not only be in the good times, so that when everything is going up, this should be spread over a very long run, maybe 5 years of trading, or back testing your strategy through the crash in 07, 08, or the Q4 in 2018, where we were down some 20%. It could be testing your strategy during the COVID crisis in 2020, and so on. It is very important that you have some solid stats, and that you're not just looking at your trading log. Let's say you started trading last year in March, and everything has been going up from there pretty much. And you're just looking at your trading log and saying, yes, I have a 95% success rate, because that will give you a completely unrealistic picture of what trading is actually all about. You might have had 95% success rate over the last year, but counting all the bad years, you might be at a 60% win rate and a 40% probability of a loss. That is one thing. Then it's also important to look at how large are my average winners and my average losers. Now this is in dollars, you could also put it in percentage, but let's just say that your winners and your losers are equally $1,000 plus and minus. Now, if we have 60% winners, that should give us a long-term probability of winning. This is what is called a positive expected value. So we can see here that we would, over some 50 trades, let's put in down here, let's put 200 trades in here. Now what would that end out as if we were risking the same amount? Let's say we have $100,000 in our account and we're risking $1,000 each and every time. Now what would that give us after 200 trades? They give us different amounts here, and as you can see, we have this looking a bit like that, but a lot more simple. I'll show you some more complex pictures in a second. Let's just get to the right picture here. But you can see here we have the best case scenario, we have the worst case scenario, we have some midpoints. So this is the most probable outcome. Now what we can do here is that we can run a simulation. We can run these 200 trades and we can do it, for instance, 1,000 times. So let's say you're trading 200 times in a year. It could also be that it'll take you 10 years to make 200 trades. But let's just say that you're trading 200 times per year. That's 4 times per week. That is more often than most stock investors, but it might be a reasonable number for a forex intraday trader. So let's try and run the simulation. Now you can't see it, but just beneath here it is counting up to 1,000. So now here we are. This is you having a win probability of 60%, and your winners are just as big as your losers here. In the best case scenario here, you earned over 200 trades, you earned $82,000. Worst case scenario is that you actually lost, $2,000 down here. And the most probable, the midpoint here is that you would make $43,000. If you had a $100,000 account, that would be a 43% return. That is of course great if you can make the 200 trades in a year, but if it takes you 10 years for 200 trades, then 43% as a probable outcome might not be good enough for you. You might want to go with a strategy where you might have at least 1.5 to 1 here, so your winners on average is $1,500 and your losers are $1,000. Now if you run the simulation again, just give it a second here to count up to 200 trades 100,000 times, boom, there we are. If you have your winners being 1.5 times your losers, you can see that the worst case scenario right now is a 40% return. You can also see here that you actually had the first 50, 60, 70 trades here in the negative. That is the worst case scenario over these many runs. And you can see here your best case scenario is that you're making 152%. Now another thing that is interesting here is the little matrix down here, because it shows you the win streak and the losing streaks, meaning how many in a row could you be winning and losing. And now the best case scenario at all, the max here is that you have 26 winners in a row, and the worst case is 14 losers in a row. That's a good number to know, because sometimes when we are sitting and we are losing and losing and losing, maybe after 10 losses in a row, we think to ourselves, oh, my strategy must be broken. But if you can see here that it is actually within the possibilities when you have run this test, then that is a very good number to know. You can see that average over all of these many thousand times here, you can see that on average you lose 5 to 6 in a row when you have a losing streak, and you win about 9 trades in a row when you have a winning streak. So this of course is a maximum, this is the minimum, and you can draw all sorts of numbers out of this. Now, as I said, I'll try and show you another free tool on the internet. This is just to give you an idea of what we're looking for. because this is pure statistics, and there's no way that this is a real representation of real life here, because there are a ton of different variables. That can be you making a mistake, it can be you being ill, or having a vacation, or getting tricked by your emotions, and there are some taxes in here and all sorts of stuff. There are a million different variables. This is to give you a mental picture of what are the possibilities in what I'm doing here, and especially to the downside, because that can help you keep your emotions in control when you are in a losing streak. Now let's have a look at this website I mentioned here. It is called forexsignals.com. I'm not affiliated with them in any way, but they have this nice tool. And if you're going up here on the free tools, you can see they have the Monte Carlo Simulator here. And looking at that, there's a bit of an explainer video here if you need that. But as you can see here, of course, they're mostly focused on Forex and day trading and so on. I'm also day trading, and I'll show you some examples of my statistics from that in here. But let's say you're thinking stock trading, and you're saying, I am sitting with a balance here of $100,000. How much do I risk per trade? Well, normally I say you shouldn't risk more than 2% per trade. Personally, I'm more of a 1% per trade guy, but we can have a look at in a second what that will mean in difference. Now, what are the winning trades? Let's say you actually have a strategy where you win 60% of the time here. And we'll just have 0 break-even trades. Now, how many trades do we take in a month? This is, of course, mostly as for the day traders, because normally when I, for instance, buy a stock, I might hold it for 6 months or a week or 2 years or whatever. So this is a bit theoretical when it comes to stock trading. But let's say that you trade 2 times per month. You buy a new stock 2 times per month. It might be that you hold it forever, but let's just say 2 times per month. And let's say we are looking at a 10-year range here, 120 months, and let's say that your winners are 1.5 times your losers. Then we can simulate returns here. I'm not certain how many times they run the simulation here, but you can see there are an awful lot of lines here, so it's probably 100 or 200 times or something like that. Now we get a theoretical picture of the probability cone here as to what are the minimum and the maximum. If we go down here, we can look at what is the worst case. I do like to look at the worst case scenario most of the time, because, well, just knowing the stock market and Forex market, day trading and so on, it can be all over the place sometimes. And also, this one does not take into account that if you're sitting on 10 or 20 different stocks, I'm looking at the max drawdown here. It's looking at about -6%, which is a very decent max drawdown. The problem is that when you're looking at that, you are not counting into this model that if you have 10 or 20 stocks and we are running into a stock market crash like last year, pretty much all of your stocks will be down. This is not really suited for that. So let's not look too much at the drawdown right now. We can see that we have max consecutive losses 7 and max consecutive wins 6. After 10 years, we will have made 76% altogether. It's not an insane amount, but it's there. Now, what is interesting here is that it gives us some idea of how many losing months, how many winning months we actually have, even though we have a stock strategy here that where we're risking 1% here. We have 100,000 to start out with. We have 60% winners, so 6 out of every 10 trades we take are winners, and our winners are 1.5 times our losers. Even though we do that, in the worst case scenario, we can sit and after the first year we will be at a minus 0.7%. Next year, 6% up, 6% up, 4.4% up, 9.8% up. Now, this might not seem like crazy numbers, and it is not. But that might be because that normally, if you're holding your stocks a very long time, your winners might be 3 times the size of your losers. So if we're doing that, we can see here that in the worst case scenario, after 10 years, our $100,000 in this simulation is going to $1 million. Now we're talking, and again, this is theoretical. There are taxes, and there are you're getting ill, and you're traveling on vacation or whatever. But this is just to give you an idea of, do I have a positive expected value here? Even with this, with a max drawdown, and I guess we could easily say time 3 or 4 here when we are talking stocks, we can see we're making 32%. That is quite decent. We're making 16.8%. That is not very much, or yes, it is very much, but in the head of many new traders and investors, 16% is nothing. They want 16% per month, but they're not getting that here. Still, you're getting 3 losing months in a row here. You're getting 26%, 12%, and so on and so forth, as you can see here. They're not bad returns, not at all. They are actually quite good returns. But just to make you aware that right now I have put $100,000 in here. But imagine you had put $10,000 in here because you were new and you wanted to be rich in a hurry here. Now $10,000 going to 120, if that were even possible, that would be great. But again, after the first year, you would be making $1,000. Next year, you would be making $4,000, $3,500, and so on and so forth. This gives you, I think, a good picture that, let's say you're starting out with $10,000 and you have a strategy where your winners are 3 times your losers and you're winning 60% of the time on average over time. And let's say you want to make a living out of investing and you're starting with $10,000. Now, how much time would it take you to reach this? And this, remember this, I know this is the worst case, but it is still a very good result, this one. If you need $40,000 to make a living, let's just say you do that. Well, you didn't do it in year 1 or year 2 or 3 or 4 or 5 or 6 or 7 or 8 or 9. Well, after 10 years, you were still not making a living. And this is what kills a lot of traders, because what people tend to do now is they tend to say, yeah, well, then I just risk some more. I risk 5% per trade. And you simulate and you can see now, yes, sir. Now we are making gazillions of dollars here, and you can see 15% per month and so on. Again, not taking into account that once in a while you'll run into a stock market crash. And if you're sitting on 10 positions, 5% risk each, and all of them are going down 50%, then your account is going down somewhere between 25 and 50%. So this is just to give you an idea of many new traders and investors are going for this, and they're saying, I'll risk 5% per trade. All right. If you need $40,000 to make a living, then when will it happen? It'll happen after 4 years. Are you patient enough to wait 4 years? And again, 5%? No, I'm not patient enough. I bump it up to 10% risk per trade. I'm risking 10% of my entire account each and every trade. Now we start talking. After 2 years, I'm making a living here, and after 3 years, I'm making 2 million. But of course you're not. Here you can see, even not taking into consideration that there is a stock market crash, you will still have a max drawdown of 61% at some times. And I can promise you that if you are risking 10% per trade, it's just a matter of time before you go bankrupt. So don't bump up your risk too much. Go for the long term. Go for maybe 10,000 in the beginning, risking 1%, but then add to your account. Have some extra work on the side and put 5,000 extra in each year and so on. It can actually turn into a ton of money. But impatience is what kills most people's balances here. Now, if you're day trading, and as I say, I'm doing a bit of that, and that is also because I have joined up with these NS brokers here. As I have mentioned a lot of times, if you are going for day trading, I would not necessarily recommend that to everyone, because the channel here is called Building Freedom, and being a day trader is actually not freedom, to be honest. It is a lot of time in front of your screen. But if you're going for that, you do need a broker that is pure ECN, meaning your trades are put directly into the market. Your broker cannot trade against you in any way. You also want a broker that have some good spreads. You want a broker that has a negative balance protection, meaning that a lot of day trading, forex trading is leverage trading. And if you don't have this negative balance protection, you might risk that you're putting $1,000 in, but all of a sudden, because you have leveraged your trading, you are down $10,000 and the broker wants that money back. So you need that negative balance protection, then you can maximum lose the amount that you have put in here. You also want a broker that have all the right licenses, that is the EU MiFID license, all of the large European license, and for you sitting here in Denmark, also from Finanstilsynet, that is the financial regulators here in Denmark. So NS broker, absolutely a good and trustworthy broker. But let's get back to the Monte Carlo simulation and looking at what if you're trading more frequently. Let's say you're sitting on a $3,000 account here because you are a day trader and you have heard that day trading is the place to go if you want to be rich. Let's say you're risking 0.5% per trade. Now this is a lot lower than many traders are doing. They are risking a lot more. But let's say right now, for instance, I have a strategy where I am winning around 65% of the times I'm trading. I have quite a lot of trades. I have actually, if I took them all, if I had the time, I would have something like 3 trades per day. So that is 60 per month. And I'm actually below 1 here. And I know many people are saying you need to have winners that are larger than your losers. But you don't necessarily need to have that if just you have enough winners. So let's have a look at here. I'm winning 65 out of 100 trades. I'm not really exposed to a stock market crash. So I'm not sitting in 10 positions in the middle of the crash. But I'm also winning only 0.8 every time I lose 1. Let's try and simulate that to see how it works out. Again, looking at the worst case, we could see a drawdown here at 18%. That is where many traders would say, all right, this doesn't work. Let me find something new. 9 losses in a row, that is possible. 19 winners in a row, that is of course nice. And we can see here that even with a nice strategy, we will have months here. And let's say if you are trading 60 times per month, this is pretty much a full-time job in my opinion. So this is a full-time job. You can still sit after a month of full-time work being down 4.3%. That is hard on your mental state. And after a year here, you have made 42%. Now, this is not the number of percentages you normally hear when people are talking about day trading. You are hearing hundreds of percent or thousands of percentages, and that's all fine, but the only reason for that is that people are taking too much risk. Now, year 2, you are making 117%. That's all good and nice, except there are taxes and, as I mentioned, all sorts of variables. But still, you're making $5,000 in year 2, starting with $3,000. And this is a full-time job. You can pretty much not have another job. Maybe if you're in a time zone where the opening of the markets are not the same time as your normal job, but then you would be having 2 full-time jobs. Year 3, you're making around $4,000. $1,000 and so on, and we are in year 9 before you actually reach a level where you have some decent profit that you might be able to live off. So what is the conclusion? Now, you cannot trust these Monte Carlo simulations 100% because they are not a complete picture of reality. But what you can do with them is that you can get an idea of what is the normal range for my trading strategy. If you're winning 50% of the time, if we put that in here, and you're taking 10 trades per month because you're a bit of an active swing trader, and you are winning 1.5 every time you are losing 1 with 50% win rate, well, how would your portfolio look like? Well, it could be at 12% the first year, and then 20, and then 3.6. And you might want to rethink your strategy and see, can I find a strategy where I have a higher win percentage? should I maybe risk some more? Should I bump this up to 2% because I actually don't have too much of a drawdown? How is my worst case looking now? Drawdown at 34%. I have some good years here, but 5.6% for a full-time swing trading job, is that enough? We have a negative year here. All of that gives you a good picture of where does my trading strategy lie on a statistical chart. I hope this made sense. I know it's a bit of a long video, but I wanted to show you all of the different aspects of this Monte Carlo analysis. As I said, forexsignals.com under free tools, Monte Carlo Simulator, that is a great place to start. There are several other Monte Carlo simulators that goes a lot more into details, but most of them you have to sign up for something or buy something. Here it is completely free, and especially if you are a day trader or short-term swing trader, it gives a lot of sense to use this one specifically on forexsignals.com. That's all for now. Remember to subscribe and all that jazz beneath the video. Take care of yourself and your money out there, and I'll talk to you again shortly. Bye for now.